everything's new, right? So historical analogs are useful. But people can't assume that it's going to play out just like this period. Some people say just like the 70s or just like the 40s or just like the dot-com bubble. Each one has certain similarities that we can learn from, like for example, whether it's fiscal driven inflation or lending driven inflation, asset bubbles in the past, periods of lower rates or higher rates, what happens when public debt is at this level, what historical analogs do we have? Those are all very useful, but every situation is unique.
Welcome to the Rose Show podcast. Thank you so much for joining us. Today, I have the honor of being here with Lyn Alden, macroeconomist analyst with focus on monetary systems, energy markets, and Bitcoin. She has a background in engineering and finance, has an amazing website, Lyn Alden Investment Strategy, and she's also written this amazing book. You might have heard of it, Broken Money. Love the book. Amazing, amazing deep dive on the money technologies within the financial system and their evolution. So how you doing today, Lyn?
I'm good. I appreciate the introduction. I'm happy to be here.
Thank you. I'm so happy to have you here today. So today we're going to explore the question, or maybe a rhetorical question, of who controls the ledger. And I like to begin with your overview of the state of the economy, markets, equities, bonds, energy, Bitcoin, and the economic cycle through your lens.
Sure, and I think it depends how far up you want to go or how long you want to go. But basically, the high level view is that a lot of this actually is technology based. Basically, that in the modern era, as we introduce telecommunication systems, the telegraph, the telephone, the internet, and all that, we got to a point where our transactions move around the world at the speed of light, and matter does not. And so we used to base our money on gold and various ways to move around gold, either legally or sometimes physically. But in the past 50 plus years, we've completely decoupled from that. And so we exist in a world where there's 160 different currencies, roughly speaking, and they all kind of have their own centralized central bank bubble and capital controls kind of around their borders. And they loosely tie together with their world reserve currency. So in the prior era, they partially tied together through Britain's currency, basically centralizing around London. And in the current era, they tie together around the Federal Reserve in New York. And so the global financial system is in some way a barter system. If say Nigeria and Korea want to do a transaction, the challenge is what do they denominate that unit in? And for the most part, it tends to be dollars, and both central banks will generally hold dollar-denominated assets. And the problem I think we're running into in the modern time is that after decades of the system, it's built up very large imbalances. And a couple of those main ones are, one is the trade imbalances and the net international investment position imbalances. So in order to supply the world with dollars, the United States has run structural trade deficits. This is kind of a feedback loop that materializes in the system. And so it results in a lot of dollars getting out into the rest of the world, and then the rest of the world takes those dollars and then buys U.S. assets with them. So they buy our stocks, they buy our debt, they buy our real estate, they buy our private equity. And so we end up having a large and larger percentage of our capital stock owned by the foreign sector. That's one kind of imbalance that keeps building. And the other one is that public debts around the world have gotten to very high levels. So Japan's obviously at the forefront of that, but then when you look across Europe, you look at the United States, many countries around the world, they've built up very large public debts, and so they're running into more imbalances on that end as well. They risk running into a fiscal spiral, which is to say that the interest expense on their public debt starts to become untenable. And I think the main pivot point we reached was in the past decade or so, right? So for example, for 40 years, you had in the United States rising public debt as a percentage of GDP, but it was offset by structurally falling interest rates. And so the interest expense, as both in absolute terms and especially as a percentage of GDP, was not particularly problematic in the acute sense. But after we got down to zero rates and kind of bounced off zero, and now we're going sideways to up, that is no longer offsetting the rising public debt. And so actually we're getting to the point where interest expense is actually becoming a very meaningful problem. And so that's kind of where the world faces itself fiscally, monetarily, and obviously there's a lot of directions we can go from that point.
Excellent overview. Thank you so much. I definitely want to start with debt. Our debt is insolvent as a percentage of GDP. It's over 122% and rising. And like you said, our interest expense is getting higher with higher interest rates. I think we're over $1 trillion in just interest expense. And now we have over 34 trillion and rising in public debt as well. How much further can they kick this can, Lyn? Everyone seems to think, oh, it's unsustainable. People know it's unsustainable, but some think, oh, it's going to end this year. Something bad's going to happen. But it seems like it can go on much longer than many people realize. What do you think?
So it depends on what starting point you look at. I mean, fascinating, the national debt clock went up in the United States in the late 1980s. One of the most successful independent presidential campaigns in modern history was Ross Perot, who ran largely on the debt and deficit. That was in the early 90s. That was kind of the peak zeitgeist for the public debt being a problem. But that was also roughly when globalization accelerated. So China connected to the rest of the world, started becoming a cheap manufacturing hub, connecting a lot of labor to Western capital. The Soviet Union fell, and all those borders and trade routes opened up until fairly recently. And so you had kind of 30 years of globalization, which was disinflationary, along with the internet and technologies and things like that. And so we kind of ushered in this era of falling interest rates. And so a lot of people that were concerned around the acuteness of the public debt back then were a few decades early. And so I think now a lot of people have gotten into their view that debts don't really matter, that it can always be pushed away. And I think that's generally the wrong lesson to have learned there, because we no longer have these structurally falling interest rates that they started with back then. Now we have, like you said, well over 100% debt to GDP, and we no longer have a structurally falling interest rate to offset some of that. Instead, I think the main kind of offset or variable to monitor in terms of timing is kind of the overall energy and productivity side, right? So if you have large deficits, ongoing currency debasement, for example, that might or might not show up in CPI inflation depending on what else is happening. If we're, building a lot of new energy production, if AI is making things way cheaper, for example, if there's all these kind of offsets, these better productivity, better energy resources, better kind of usage of every dollar, then you can get that offset where there's more dollars, but things still are not rising too much on average. However, if you get energy shortages, if AI does not give the rapid productivity growth that some of the bulls think, then you don't have those offsets. And I think that's the biggest variable to probably monitor is what is going to be like the magnitude of those offsets over, say, the next 5, 10, 15 years versus the rate of fiscal spiral and debasement that's happening on the other side of the equation. I tend to lean towards I think AI is going to be a deflationary force on certain types of wages, especially white collar wages. But I'm not as I think the energy section is where we could have some material kind of cost increases. Maybe not the next 12 months, but as we get further into this decade, I think that's a realistic concern.
Great points there. Thank you so much for that. When we talk about this public debt, it's always a burden on the people, adds to taxation and further fuels inflation and leads to monetary destruction, or actually further monetary destruction. Our purchasing power has been on a steady decline. When I pull up the Fed chart since the 1950s, you just see a steady decline. Unfortunately, CPI underrepresents the true decline in purchasing power. And in my opinion, we need to look at other alternative forms like shadow inflation. And then you look at trueflation, the compounded aggregate inflation, which is in the 20%. So I want to go into your tweet that you put out today. You have excellent tweets. I love this. You say we are in an era where fiscal deficits are structurally larger than the rate of bank lending and are set to grow. And so fiscal details tend to matter more than monetary ones. Could you explain your thinking behind that so everyone can understand the importance of this fiscal?
Sure. So in most decades in modern U.S. history, um, there's two major sources of money creation, broad money creation. That's different than base money. And one major source is bank lending. So when banks make loans, they create more broad dollars. They're basically leveraging up the monetary base at a higher ratio. And the other way to create broad dollars is to run very large fiscal deficits that are then monetized either by the central bank or at least the commercial banking system, basically these other fractional reserve entities. And during, for example, the 1970s, even though the United States was running fiscal deficits, the most of the money creation was coming actually from bank lending. And that's because the baby boomer generation was entering their home buying years. So they started being born in the late 1940s. And so by say the early 70s, they were entering, 25 years old, and they were starting to do household formation, and that's a period of greater credit utilization. And so largely due to demographics, you had a bulge of credit growth. There were other decades that were more mixed, but in the current era, a lot of our money supply growth has come from the other angle, which is from monetized fiscal deficits. So it's not that bank lending is excessive; it's fairly muted. Instead, it's very large structural deficits that are not right now, but in the grand scheme of things, generally supported by the central bank or the commercial banking system. And that's where a lot of the inflationary pressures and the money supply growth comes from. And so a lot of analysts have been kind of trained to look at credit growth and credit contraction as the dominant kind of mover of the economy, whether or not we're going to have an expansion, whether or not we're going to have a recession, how much inflation is going to happen or not happen. Is it going to be disinflationary? A lot of that has historically been driven by credit growth, but instead we've kind of gotten past that, and now it's more about the fiscal side. And the last time that the United States was in a similar position was in the 1940s. And so during that whole era, coming out of the Great Depression and fighting world wars, we had very high inflation, we had very high money supply growth. But if you look at bank lending, that was not where it was coming from. It was coming instead from the obvious source, which was large monetized fiscal deficits, which were going to support the war. But then more broadly, they were, you're on one hand you're fighting a war, but on the other hand, what you're doing is you're building manufacturing facilities. You're hiring people to work in those. You're when the GIs came back from combat, they would pay their tuition to go to, training, right? This is a lot of it was actually spent domestically. And so you had that more industrial policy, fiscal policy type of inflation. And so we're kind of in a similar situation now, with the difference being the types of things we're spending on. Instead of a young population, we have on average a more aged population. And so a lot of the ongoing fiscal support is things like Social Security, things like Medicare, things like still defense spending, obviously, and then for a period of time we had stimulus checks, we had PPP loans that turn into grants, which were another type of stimulus check, and so all of this has essentially been accumulated fiscal on the economy, which is the bulk of where the money supply growth has been coming from in recent years.
Thank you so much for that. Now, just mentioned the 1940s, and I know on your website, this is over a year ago, maybe two, I don't even recall how long ago it was. You made an excellent point, and you compared the 2000s, 2010s, and 2020s, and you said it was a quantitative rhyme. I love that word, that term, to the 1920s, 1930s, and 1940s. And I believe you just compared the 20s to the 40s. So could you tell us about your thinking with that quantitative rhyme and how these 3 decades rhyme with each other?
Yeah, so a lot of that comes down to where money supply growth is coming from and whether or not the private sector or the public sector are leveraging themselves. So, for example, in the 1920s, a lot of the money supply growth was in the private sector. There was basically a boom time, a lot of credit, and this was in large part due to the aftermath of World War I and some of the imbalances that built up from that period of time. Basically, you had a lot of credit growth. A lot by the end of the decade, you got into a lot of speculation. People were taking out debt to buy stocks, for example. There was a lot of farmer leverage for new farming techniques and things like that. And that eventually ran into a peak and a crash. And then the problem is they built up so much credit in the economy relative to the base money. And then you started to get failures of fractional reserve banks. You started to get mass unemployment. You went to this kind of Great Depression period, and you got a private sector deleveraging. So money supply was actually destroyed because people thought they had money in the bank, but of course the bank's only fractionally reserved. And back then there's no FDIC insurance, and it's harder to print money. And so your bank just says, "Oh, sorry, we don't have the deposits that we said you had, that you thought you had, are actually not there. They were fractionally reserved all along." And so about a third of the money supply was destroyed. And so the 1930s were this more disinflationary era. We had private sector deleveraging and money supply destruction, which was partially offset by public sector stimulus programs and money supply growth. And then you go to the 1940s, and by that point, the fiscal side completely dwarfed the private sector side. So the private sector deleveraging was mostly finished, and the public sector was just pouring out, 20% deficits as a percentage of GDP year after year after year, for the war effort, for manufacturing facilities, for all sorts of things like that. And so that was a more inflationary decade, and it was not because of credit growth, it was because of monetized fiscal deficits. And so if we fast forward to the current period, the 2000s were in many ways like the 1920s in the sense that you had major private debt bubbles building up. You had people, bidding up the price of houses and using very aggressive financing strategies to afford them. And we hit a record ratio for how much, for example, broad money there was compared to base money, or how much bank loans are in the system compared to how much cash banks actually have on hand. And that all hit the crescendo in the great financial crisis. And so we started to go through a similar private sector deleveraging, but this time FDIC insurance and more rapid bank recapitalizations and stimulus, things like that. So instead of getting outright deflation, instead we had this kind of period of disinflation. So we got, on one hand, private sector deleveraging, but on the other hand, very rapid fiscal support, largely for the banking sector, not really the homeowners, but largely for the banking sector. And so you had this kind of like balanced decade where disinflationary forces and inflationary forces were roughly offsetting each other, and you had pretty slow economic growth. It was kind of, there's been some analysts that refer to it as a silent depression, which I think is a pretty useful term. It's less dramatic than, the Dust Bowl of the 1930s and the outright money supply destruction, but it's kind of like a more muted version of that. But then when we got the pandemic, the lockdowns, the stimulus checks, the PPP loans that turned into grants, the corporate bailouts, all of that in the early 2020s, that looked a lot like wartime financing. That looked a lot like monetized fiscal deficits. And so I made that comparison. And in more recent years, unfortunately, there's even more outright war. There's more outright kinetic types of conflicts globally as well. So overall, this is shaping up to be a decade that's, I mean, hopefully not to the dramatic degree of the 1940s, but it's a very fiscally driven decade. It's one where large fiscal deficits that at times are supported by the central bank or the commercial banking system override, say, the lack of bank lending or other disinflationary forces in the economy, and cause this more structural background types of inflation, and kind of, pockets of growth in the economy versus pockets of shrinkage elsewhere.
Thank you so much for that. Now, going further with brilliant comparison that you made. I loved it. I think it's excellent, makes a lot of sense. And so we know that the fiscal is fueling this inflation. So do you believe we are in for a secular inflationary period upcoming? And what do you foresee, just your idea, what you foresee for the 30s, in the late 2020s into the 30s. What do you think could be part of this pattern?
So in general, I think that the 2020s and probably the 2030s, I mean, the further we go out, obviously the harder it is to see
Of
things.
course.
But I think that this general era is going to be characterized by higher average inflation than the 2010s. Um, and that the closest comparison really is that 1940s era, that really fiscally driven era in developed countries globally. The other comparison is kind of what you see in emerging markets today, where recessions look different in emerging markets. Um, Another way of putting it is that there have been a series of bubbles, and I'm not the first one to make this observation, but
Hmm.
basically, um, they blew up the dot-com bubble, and when that, started to collapse, they instead kind of pushed it up to the housing bubble. And when that started to collapse, you kind of push it up to the public level, right? So you debase the money, you push all the public debt up to you take out the private sector debt, you push it up to the public sector debt over a period of time. And the problem is that there's nowhere really else to push it beyond that point other than into the currency itself. The currency itself gets debased. And so I think going forward, the main question is as that currency debasement occurs, where does it show up in terms of higher prices? Because if you get very rapid, say, AI productivity or energy supply growth, then the price increases are likely to show up in anything that's scarce. So um, Bitcoin, gold, high quality real estate, the stocks that are leading these trends, for example, that's a lot of it's going to accumulate in asset price inflation because you have more dollars chasing these kind of scarcer goods. On the other hand, if you don't get energy abundance and you don't get the materials you need, copper, for example. If you have these bottlenecks, maybe supply chains, maybe it's driven by geopolitical frictions that they're building up now compared to, where they were a decade or two ago. If you have more frictions in the system, then that dollar debasement is more likely to show up in what we would consider CPI inflation, things like gasoline prices being high, therefore the cost of shipping being high, the cost of manufacturing being high, the cost of basic services going up. And so I expect on basically to have a combination of those things. And so I tend to be an energy bull. I do think that, CapEx is probably going to have a period of being insufficient to meet demand. Within that period you mentioned, maybe the mid to late 2020s, if not then maybe the 2030s, and that would be a period where they probably would have to, high energy prices followed by a lot of energy CapEx to kind of deal with those higher prices. And so you get kind of a combination of both. So I tend to be in the view that this is a decade where you want to own real assets more
Hmm.
so than just kind of the disinflationary assets that really benefited from most of the past 40 years, which was, for example, the large cap stock indices and the bonds.
Thank you so much for that. So you're an energy bull, and you, just like I do, believe in real assets, very important, especially in an inflationary period. You want to have the real assets. We know that, real estate has been a hedge against, in the past, has been a hedge against inflation. So just an example of real assets. So Lyn, could you give us some examples? I know on your website, and I urge everyone to check out not only your amazing book, but your website. And you do share some of your investments that you hold. So if you could share with us, what type of energy are you bullish on? Uranium, renewable sources. We know you're bullish on Bitcoin, obviously. Real assets. Like, what are some ideas of what you're bullish on?
So I've been bullish on uranium for a number of years now. It has gotten more richly priced. I think
Mhm.
there's probably still growth ahead of it. But I guess my highest conviction area in the energy sector is the large and medium-sized energy producers that have very long-lived reserves. Basically, a large number of years of production worth of reserves, and that have access to really good financing. So, for example, they basically took out long-term low interest rate corporate debt. So they're basically shorting the fiat currency
Mm.
long-term at low fixed rates. They have decent amount of cash reserves, which are interest rate adjusting, and then they have all this infrastructure in these reserves to produce energy long into the future. The reason I like those is because they are basically positive carry hedges on energy. So at the current oil price, they're profitable. They have great balance sheets. They are inexpensively valued, so low valuations relative to their earnings, their free cash flow, the strength of their balance sheet. They pay dividends, so you get paid to own them. And so even at current prices, you're often getting a 8% earnings yield, 10% earnings yield, 12% earnings yield, which they can plow into dividends and buybacks and acquisitions and all sorts of, whatever they want to do. You want to find one, obviously, that manages the capital well. But then should you get an energy spike of some sort, if there's insufficient capex relative to demand, if there's any period of accelerated currency debasement, they're well positioned for the upside. And they're not over-owned in the way that many other assets are. So I like that to protect my other assets from the prospect of energy issues in the future, while still benefiting to a moderate degree if energy just kind of roughly stays like it is now in terms of pricing. Real estate, I think we have to be a little bit careful with because, in the 1970s, real estate was relatively cheap compared to incomes, right? So say the average home price relative to the average person's annual income was a lower multiple than it is now. So after decades of falling interest rates and a lot of asset price appreciation, the valuations are not as attractive on average. Obviously, real estate's a very localized market. Markets that are not that expensive. Back when interest rates were lower, I was kind of supportive of real estate as, especially in linear
Mm-hmm.
markets as a place to store value. And now it's somewhat less so. But in general, I think that basically exposure to inexpensively priced real assets, especially if there's some sort of basically a fiat currency short attached to them. So long-term fixed rate, low debt attached to assets, either a legacy mortgage or corporate bonds. You're short in the currency in some way while you're holding scarce assets, cash flow producing assets, and things like that, as well as obviously selective technology where it makes sense, bunch of other sectors where they make sense, and assets like that.
Thank you so much for that. I agree completely about real estate. It's very regional, but it's changed dramatically, and it's a higher percentage of a person's income. And with rates are directly tied with real estate, and we know rates are most likely going to remain higher for longer, especially with this inflationary period we have. So definitely be careful in that area. I tend to think a lot of markets are probably set to come down. And then commercial real estate, oh my gosh, what's going on over there? We know that. Okay, let's go into one more part of the real assets. What are your thoughts on gold? Gold, the metals, and all of those.
So gold has held up fairly well considering the move in interest rates. So if a few years ago, if you asked people if interest rates go from 0 to 5%, what is gold going to do? Most people probably would have thought it'd be lower than it is now. So the fact that it's kind of held where it is pretty remarkable. There's a lot of central bank buying. It's the kind of reserve asset of choice for central banks that are concerned around the dollar being frozen or the dollar being debased, depending on what their particular view of that is. And so the fact that you have a scarce money that can be self-custodied, that it can't just be unilaterally frozen, is attractive. And so I expect in the years ahead for gold to probably do pretty well. I think the main competition for it is from Bitcoin, because gold and other metals historically there's multiple markets. Obviously, there's the central bank market, but then there's also the retail market, and some portion of the retail market is now prefers to own Bitcoin. And then even some of in small amounts, even some of the sovereigns, for example, the Kingdom of Bhutan was mining Bitcoin. There are some of the Emirates that are getting into Bitcoin related assets. Singapore has been looking at that area, right? So around the margins, El Salvador is another example. So around the margins, that is interesting to some countries as well. And so monies do compete with each other. So I generally view Bitcoin as the likely outperformer. But obviously it's the younger, more volatile one. It relies on, the global internet being roughly functional. It relies on things like that, whereas gold's more of like the fallback, and the analog money. So I'm generally bullish long term on gold, with some caveats.
Thank you so much for that. Now, like you said earlier about the energy companies, to me, they're the cash generators. They're the ones that have low debt and they're capitalizing during this time period. So what about the tech? Now, NVIDIA, today's a big day, NVIDIA earnings. By the time this airs, everyone will know what happened. But there's SMCI. There are these companies that are at the forefront, right at the center of this whole AI movement, and they are set to capitalize. And I tend to think that the AI deflationary will really flow to the few more, unfortunately, than the many. And it seems that these companies that are right there at the center will benefit the most. So what's your thoughts with NVIDIA, SMCI, and there's quite a few others as well in that space?
So I'm generally bullish on their underlying fundamentals as a group. I think that their revenues and their earnings are going to be higher in the future than they are now by a pretty meaningful degree. But obviously, the market has bid up the valuations with that
Mhm.
expectation in mind. Um, and so, while I'm not one, for example, to call Nvidia a bubble, that I think it's going to collapse all the way back down to where it was before. Um, I'm also not exactly. It's obviously a very crowded space now.
Mhm.
It's well priced in, um, and last I checked, it's like a 1.8 trillion dollar company, which actually
Mhm.
you can argue makes sense for the leading AI hardware company in the world. But then the question is, if you're looking to invest, you want to say double your money over a reasonable time period. So what's the chance that they're going to become a 3.6 trillion dollar
Mhm.
company within an investable time horizon? And what's the chance that they double from there? At these, they have to they have to grow their fundamentals into the valuation they've already reached, in other words, which I think over time can happen unless they're disrupted by another competitor. Um, and so, I think that while there are areas of interest in that broad sector, I think that that's not where the kind of the value is at the current time.
Mhm.
So I've been bullish on Adobe back when they were cheap. Now they're expensive. I'm bullish on MicroStrategy. They business intelligence and Bitcoin and they use AI and all sorts of stuff like that. There's pockets of things that are valuable. Um, but you have to be really careful about valuation. I mean, all the companies that got bid up in the late 90s, um, you know, people about the internet were roughly right. It did transform things over the next 20, 25 years. But some of the valuations at that time already priced in like 10, 20 years of that. And only a handful of the companies actually went on to provide really good returns after the valuations got washed out. So I think that investors should be kind of sober and cautious when determining how to allocate capital to that space and think what else can I allocate to so I'm not like all in on these types of names like a lot of the big stock indices kind of are.
Well said. I love your mindset, Lynn, how you look at it as, from all sides. And that is so important for investors to say, okay, even though they're the leader and the king of all stocks, we have to look at the valuation. And the most important thing is to look at the future, and you want value. You want to have that greater return, a greater risk return profile, and you want to have greater returns for your risk. So, that's important. So well said and great points. Thank you so much for that. I want to go into liquidity. Liquidity is key for everything. And I know you watch liquidity with Bitcoin very closely. But there is liquidity in the system. We saw the market have a nice run from, the bottom was in October, November. We had a nice run until now, and it's been some rough time right now this week, probably a much needed correction pullback. But there is liquidity. Now, everyone seems to think there's QT, there's so much tightening going on, but actually, the Fed has injected liquidity through the BTFP, and then there's also been the Treasury with the short duration. And you are an expert in all this stuff, so please, can you tell us about this liquidity that actually has been going on behind the scenes that many people don't even know about?
Right. So there's domestic liquidity and then there's the broader picture of global liquidity. So if we focus on domestic liquidity,
Mhm.
throughout much of 2022, for example, we had declining liquidity. The Fed was doing quantitative tightening. And so they're reducing the amount of base money in the system. The Treasury was not offsetting that, so you had overall net declining liquidity. Starting in late 2022, the Treasury started to provide liquidity back into the system. At first, they were doing it by drawing down their cash balance, their Treasury general account. They were pushing cash into the system, and they did that, largely due to the debt ceiling issue at the time. And then after that period resolved by mid 2023, they instead started pushing liquidity into the system from the reverse repo facility. So there's a lot of jargon there, but basically the reverse repo facility was this pocket of about $2 trillion worth of excess liquidity that was built up during the pandemic stimulus. So during the Fed's really fast rate of QE, they basically flooded the system with so much cash, and a lot of that cash kind of poured into this reverse repo facility. And there's a lot of reasons for that that we don't have to go into right now. And that was basically dead capital. It's kind of stuck out there. It's outside of the financial system, and the Treasury tapped into it by shortening their average debt duration. So instead of issuing, for example, a lot of 10-year treasuries, they would issue a lot of 3-month T-bills, for example. And that allows them to kind of tap into that reverse repo facility and start pulling some of that $2 trillion out of that, kind of dead pocket of liquidity and back into the financial system. And so the real story since late 2022, so going on almost a year and a half now, is that while the Fed continues to be relatively tight, the Treasury has been positive for liquidity. They've been pushing liquidity into the system in various ways, and so we've kind of been in this flattish liquidity environment, flat to up, in fact, for ever since that time. And the Fed, for their part, so during the March 2023 banking crisis, the Bank Term Funding Program, it was a net liquidity injection, but since then they've offset that by continuing to do quantitative tightening. So the Fed on their own is still, generally speaking, a reducer of net liquidity, and it's really been, for the most part, the Treasury that has been offsetting this.
Mm.
But of course, they can only do that until the reverse repo facility is run out. And at this point, it's got about, $500 billion left in it. And so they've kind of tapped into 3/4 of it. There's still another quarter that can go into the system. And at that point, we probably would start to see the Federal Reserve stop their quantitative tightening and start to go to maybe a more neutral liquidity situation. But that's kind of a thing we have to navigate as we get closer to that time. The other big factor is global liquidity, which takes into account all those types of factors I just mentioned. But then the other big factor is how strong is the dollar compared to other major currencies. And the reason that's relevant is because a lot of entities around the world, both sovereign governments and corporations in different governments, have debt denominated in dollars. And for the most part, it's not even owed to the United States, it's owed to other countries. For example, a country will owe dollars to China, they'll owe dollars to a lender in France, they'll owe dollars to a lender in Japan, for example. There's this interconnected web of assets and debt out there, and a lot of it is dollar denominated. And so if the dollar strengthens relative to other currencies, it means that their debts are appreciating compared to their
Mm-hmm.
cash flows. On the other hand, if the dollar weakens compared to other major currencies, their debts shrink relative to their cash flows, which is good for liquidity. And so right now, the dollar is relatively strong, which is somewhat keeping a lid on global liquidity by keeping all these indebted foreign entities relatively pressured. And so that's, it's kind of a mixed bag overall for global liquidity.
Great points there. Thank you so much for that. So taking that, what's been going on since the end of 22, and now the reverse repo is draining. What do you think is going to happen? You said that the Fed is going to tend to go more neutral, maybe reduce its quantitative tightening. And do you think that the Fed is going to be pivoting? I know the market has priced in, I think, like 6 rate cuts this year, but this is 2024. Do you think that we're going to go more neutral, less restrictive, although inflation is still an issue? And do you think that the Fed will be cutting rates this year, or at least maintaining them a little longer? What are your thoughts with all that in the Fed policy?
So I treat the balance sheet size and the interest rates as pretty separate categories,
Mm-hmm.
because one is more about liquidity and one is more about trying to increase or decrease the rate of bank lending.
Mm-hmm.
Um, and so basically, as all these fiscal deficits pour into the economy, that's stimulatory and it's inflationary. And so the Fed's main tools for controlling inflation are different tools that can determine how much banks are likely to lend. So if they lower interest rates, everybody wants to
Mm-hmm.
borrow debt. If they raise interest rates, people are obviously more hesitant about borrowing. They also have to then consider what the bank's going to want to do. Are they going to want to lend at low interest rates or higher interest rates? But right now, they're trying to slow down bank lending, and it's been relatively successful, but that's offset by the fact that there's so much fiscal deficits
Mm-hmm.
pouring into the economy. And so I think their issue is that their interest rate tools are just not very effective for what they're trying
Mm-hmm.
to do. They can only indirectly address the problem. They can't directly address the problem, which is largely a fiscal situation. Um, and so I think they're more in a holding pattern now. Trying to predict what 12 humans are going to decide later this year is not really something I focus on too heavily. I think that the more that CPI prints come in hot, and the more we're seeing early signs of potential reacceleration of inflation and reacceleration of manufacturing. And should that continue, that will probably cause the Fed to be a little bit more hawkish than the market expects. On the other hand, if some of that data, kind of decreases somewhat, we probably would expect get back on track towards those rate cuts. But the separate factor is their balance sheet, and I think that's largely going to be determined by the liquidity of the Treasury market, more so than inflation. So, for example, back in 2019, there was something called the repo rate spike. Which is where the repo market, basically the rate that different financial entities lend to each other overnight, that blew out. And the Fed had to come in and fix it. And then, moreover, they had to stop reducing their balance sheet. So back then, they were doing quantitative tightening, and they had to stop doing quantitative tightening. They actually had to shift towards doing kind of slow amounts of QE. And that was all shortly before the pandemic. That wasn't a response to it. That was all kind of their own fiscal dominance liquidity issue. So I think that their balance sheet reduction is going to be less determined by inflation and more about the treasury market or the repo market and things like that. Should there be an acute liquidity problem in the system, they would be practically forced to come in and put that fire out with their balance sheet. And I think that's what largely determines when they, say they run out of the reverse repos and they get to a point where they're unable to keep doing QT without causing some of those types of problems, and then they shift to a more flat balance sheet or a mildly upward balance sheet, kind of regardless of what CPI is doing at that time.
Well said. Yeah, absolutely want to avoid any liquidity crisis. As we saw from the banking crisis, having unrealized losses on their balance sheets, very concerning. We had some collapses occurring, and it seems that the bank walk, as some call it, is still going on because of the higher rates and the money market. But yeah, well said. I mean, the interest rate, everyone's so focused on the Fed with the interest rates, and I guess, with the markets and trading, it becomes a big issue, but those are just not the proper tools to control the inflation. And like you said, it affects the bank lending more than anything else. So thank you for that. Now, Lyn, we talked a little bit about the 2030s and what you saw, what potentiality there. And a lot of Austrian economists tend to talk about it's like a repeat of the 1970s plus debt. Others that I'd met with and spoken with said, oh, it's going to be a combination of 2000, 2008, because of this insolvent debt that we have and all this fiscal. The Fed is helping with liquidity. It's a different time period than we had in the past. We're in a different world now. But what do you foresee for the markets, the economy this year into the end of the 2020s?
So I think you put it well that, everything's new, right? So historical analogs are useful. But people can't assume that it's going to play out just like this period. Some people say just like the 70s or just like the 40s or just like the dot-com bubble. Each one has certain similarities that we can learn from, like for example, whether it's fiscal-driven inflation or lending-driven inflation, asset bubbles in the past, periods of lower rates or higher rates, what happens when public debt is at this level, what historical analogs do we have? Those are all very useful, but every situation is unique. So I generally find that the 40s are the closest analog.
Mm,
If anything, the 1940s in the UK are the closest analog to the United
mm.
States today, which is basically you're the incumbent power, you've built up a lot of debt, you have a structural trade deficit, and you're now entering kind of fiscal dominance, which is that the large fiscal deficits are a larger force on the economy than bank lending. And so that's really where I view the United States being in today. On average, I expect relatively sticky inflation above the Fed's target. Um, I expect there's big tail risks we could see from geopolitical events that it's hard to model in advance. But if anything, they're more likely to surprise in the worst direction than the better direction. Basically, there's more things that can go wrong that go right in many ways. So that's all a risk for supply chain disruptions, energy disruptions that should be kind of factored into potential valuation analysis. We're seeing early signs of reacceleration. So, for example, purchasing managed indices, conference board leading indicators, these various kind of rate of change estimates for the economy, they were falling throughout late 2021, all through 2022 and 2023. They started to flatline around kind of the second half of 2023, and we're seeing early signs that they might be turning back up. You might be seeing a reacceleration of inflation, a reacceleration of manufacturing, that the fiscal side might be kind of taking over compared to the tighter monetary side. And if that occurs, then I think there are interesting investments that are available in the energy space, for example. Energy kind of been this thing where in 2022 it was a good investment, most other things were bad. In 2023, energy cooled off while other things resurged. And I generally continue to like that energy lack of correlation to other assets. So if someone's concerned about, say tech stocks falling, for example, there's really two main ways that that can happen. One is that their earnings fall short, that the economy weakens, that their tech adoption does not take off as quickly as possible. But the other one is valuations. So for example, if energy price spikes, or if inflation kind of reaccelerates and the market price isn't higher for longer, and says, okay, what about 5% interest rates or 6% interest rates for longer? Then suddenly the valuations of some of those tech stocks can be pressured, while some of these other things can hold up pretty well, like energy stocks, for example. And so I'm not trying to predict too much what's going to happen in any sort of 6-month or 12-month period, but given that early sign of reacceleration, and seeing how crowded the market is into tech names and how it's completely uninterested in energy names, I prefer that kind of risk-adjusted area at this time, at least for an overweight position in a portfolio, not like an all-in strategy, but
Mm-hmm.
basically saying that I like to protect my more disinflationary assets with those other assets like energy that do better in that more inflationary environment.
Love that. Diversification and always focused on the risk adjusted returns. Well said. Thank you so much for that. Um, there's this talk about soft landing, hard landing, no landing. And just like to get your thoughts on what you think about a recession. Everyone says that the recession is baked in. Many economists have said that they anticipated it late this year, some early next year. What are your thoughts on a recession? Is it inevitable? Do you think it's headed our way, or do you think stagflation is still a possibility?
So I've been monitoring this for a while now. In 2022, my view was we were heading towards recession. But when we started to see by early 2023 signs of fiscal dominance, that the fiscal side was overriding the monetary side, I started to change my view on that. And that's still roughly the case, that there's no clear sign of recession on the horizon.
Mm,
Um, and that's largely because of the fiscal side.
mhm,
And another way of thinking about it is that it's better to think of it sector by sector. So, for example, if we have wider than normal divergence between fiscal policy and monetary policy, so very loose fiscal policy, very tight monetary policy, it means that certain sectors are going to diverge from each other more than average. So interest rate sensitive sectors like commercial real estate, for example, I would expect to continue to have recessionary conditions,
Mm-hmm.
while more businesses that are focused on travel, dining, technology, maybe healthcare, um, that I would expect to continue to hold up fairly well, which on average are a larger share of the economy. And so I tend to view us as in more of a stagflationary or more of, I've been using the phrase emerging market landing, which is basically when the currency itself takes some of the brunt instead of a harder landing.
Thank you. Well said. I like that emerging markets landing. We're going to coin that as your term. I love that. That's really cool. I like that. Thank you so much, Lyn. So, I want to talk about entropy. In your book, you have this great, I love all the chapters are great. I tend to love part 4, the entropy of fiat ledgers. I think that's very important. They're all great parts. But so I want to go into this move that it seems inevitable, moving from a centralized to more of a decentralized world. It seems inevitable and necessary. And we have to just go right into Bitcoin. Bitcoin is the epitome of decentralization. It's immutable, incorruptible, and it gets stronger and stronger. Finite supply, 21 million. The ETF helped, I think, bring more widespread eyes on Bitcoin. And I don't want to just talk about the money aspect, because Bitcoin is so much more than money. It's social, it's giving help and helping others in the world that don't have access to money. So tell us about Bitcoin and the future.
Right. So in the past several centuries, we've had this general trend where most frictions in finance were addressed by more centralization. So if we have frictions moving gold around, for example, it's expensive to move and secure and authenticate gold with every major settlement. Instead, we will go and trust a third party. And if you and I want to make a transaction, we just go to that third party and say, hey, take some credits out of my account and put it into her account, or take some credits out of her account and put it into my account. And so the ownership of that gold is basically recorded on a centralized ledger and moves a lot more frequently than the gold itself. And then when you had a lot of those, you kind of tie into even another layer, central banking. So even if different third parties want to transfer value, they hold their reserves at an even bigger bank, and they just go to that bank and say, hey, move my account, these many credits from my account to their account. And so we had this increasing tree of centralization around the world to address most of the problem where transactions and information can move around the world at the speed of light, but physical money could not. And then even when we drop gold from the system, at least for the most part, it's still there for central bank collateral. But when we mostly drop that out of the system, it relies still on these very centralized ledgers. And the two issues with that is it means a central authority can, one, determine how much units exist. And especially when you look at the long tail of 160 different currencies, a lot of them get debased pretty quickly. And that's what people's savings and wages are denominated in. And the other one is they can control who can transact with someone else, or whose money gets frozen, what payments can be made. And Bitcoin's kind of the first major break of that trend, which is to say that now that bandwidth and other thing, encryption, hardware, bandwidth, a lot of these things have improved to the point where now we actually have decentralized ways to send and update a ledger around the world. So instead of one central entity managing a ledger, we can have multiple separate entities kind of work together to do that ledger in a rules-based, energy-backed manner. And so it's very hard to censor it, it's hard to debase it. And so that's kind of a trend shift in what is available to us. And so I think that's a technology worth leaning into. And it's obviously, it's 15 years in now. It's been going through tests. How robust is it? Is it the best way to do it? Are there other ways to do it? What other things can we do with this technology? There's also the importance of other sort of open source protocols. For example, there's Nostr, which is a social media protocol that's, it allows kind of different ecosystems to connect to each other open source. So for example, if you're on one social platform and you're censored, or you're on another social platform and you're censored, there are these open source alternatives. And I think basically we're in this environment where money systems and information systems are more likely to be kind of tightly controlled and censored, and basically have frictions imposed on them And these open source alternatives, whether it's about money or information, are basically release valves for people to go around those blockades and build things to kind of strengthen those types of networks over time. I think that's really important.
Very important. Thank you for those excellent points. A lot of people, and I have to ask you this, because a lot of people they think that fiat's going to collapse. And they think that, a lot of the Bitcoiners are saying Bitcoin's going to replace fiat. Now, When Money Dies, a great book that talks about the collapse of fiat and that all money does eventually die. What are your thoughts on the coexistence of Bitcoin? I think that tends to be more of my thinking. I think that Bitcoin is like an alternative and global reserve asset currency. But eventually, do you think that fiat will collapse? It may not go out with a bang, but instead with a quiver?
So historically, they all do. They're all generally unsustainable. They can take a lot longer than people expect before they collapse. Basically, all the debt that's denominated in those currencies
Mhm.
represents demand for those currencies, and so they can take a long time before they lose all of their value. And then even when they do lose their value, they can be reset. The centralized entities can basically cut some zeros off their currencies and basically start over. And so I think that over time, Bitcoin kind of eats into these 160 fiat currencies. Basically says if you don't want to have your centralized debasing one, here's this decentralized open one. But obviously, it has to go through a series of challenges. Every year that it doesn't get blocked, censored, hacked, it basically gets stronger and stronger over time. And as long as that trend keeps happening, I do think that there's a long period of time where there's coexistence. But at the kind of the end of the tunnel, I think that it's going to be increasingly untenable for a lot of countries to have their own fiat currencies. Maybe the major ones will find a way to hold on for that for a longer period of time. But I think starting with the long tail of weaker countries, it's very hard to maintain those currency monopolies.
Thank you so much, Lyn. My last question, I just want to wrap up. This has been amazing. Thank you so much for this and for the audience. It's always so amazing to watch you speak. What is this correlation between liquidity and Bitcoin? I know you've been tracking it very closely. And what do you envision for the future with the Bitcoin world?
Right. So when you're comparing the exchange rate between, for example, dollars and Bitcoin, and dollars are the most important comparison because it's the global reserve currency, um, you're doing a fundamental currency analysis. You're saying what are the fundamentals between these two? So Bitcoin's obviously more scarce, it's energy backed, it's open, the dollar is debasing, and it's controlled. But it does go through periods of tighter policy or looser policy. So, for example, if interest rates are zero, and the money supply is growing, there's a lot less reason to hold dollars relative to anything else. On the other hand, if the Federal Reserve increases interest rates to 5%, and now you have positive real rates, that's a hardening force on the dollar, at least temporarily. And so other things that are denominated in dollars kind of contract a little bit. They get squeezed a little bit. And so global liquidity is basically a measure of saying, okay, what is global broad money supply denominated in dollars, because that's relevant for all the global dollar denominated debt out there. And generally speaking, when that's like stagnant or falling, normally Bitcoin is having a correction or a consolidation. And normally when that's rising, Bitcoin is going up. And that makes sense because you're comparing basically this smaller, growing, harder money compared to a bigger incumbent money that goes through cycles of loosening or hardening. Um, and so over time, I think that Bitcoin becomes this connective tissue that ties a lot of other currencies together, and basically represents kind of a peer-to-peer store value and kind of payment method for people in all different countries in the world. And we just have to, every year is another test for it. Can it be
Mhm.
stopped? Can it be hacked? Can it be centralized? Can it be permissioned? And every year that it does not, I think it's going to, over time, in kind of rolling 4-year periods, continue to take market share and displace some of these other systems.
Thank you so much for that. And I urge everyone to check out Broken Money. Excellent book. Thank you, Lyn. This has been amazing. Thank you so much.
Thank you.